I mean, first of all, the eclectic and somewhat volatile style and the way this stuff comes up. So we're talking about 200 billion of a $17 trillion trade. So it's more meaningful than, in the past. But, I think I don't want to say I'm dumbstruck, but what I will say is the market's done a good job of becoming more and more desensitized to a lot of what's going on in the trade rhetoric.
You say that, but if we looked at futures this morning, indicating that the market is concerned. I mean, we may have gotten past the trade issue on Monday, but fast forward to today, to Wednesday, a couple of days later, it's back on the front page for Wall Street. Yeah, the market will dip and it'll come back. That's the way it works. I mean, so you can't be too short term with this, because if you reacted to everything, you'd absolutely, as an investor, blow yourself up. I mean, you really have to look. A lot of this is the market trying to figure out what's really going on here. Trade is really an interesting thing, right? Clearly, it really in the U.S., for example, people don't have a general problem with sort of the administration going after the trade. Perhaps it's because they won't, see that the cost of shopping at certain stores they like. Let's say Walmart imports a lot of stuff made in China. What that impact would be, but they easily gravitate to the argument that is, getting some traction. For example, here's a narrative that's actually starting to get a little bit more footing in the marketplace institutionally, which is, maybe the U.S. trade policy, since which is founded on post-World War II, ideas that you can't have, strong military capabilities in your allies unless they are strong economically, right? So, right after World War II, the Truman administration literally adopted, Europe was really down. There was, basically a lot of rebuilding. There wasn't a lot of money. The U.S. actually, got much less domestic impact and had plenty of money, plenty of demand. The trade approach that this administration is doing is tossing that to some degree. That's actually becoming popularized in the investment community. This, the notion that we would, with our allies, continue to have that. And that kind of dovetails with this other narrative, which is you have a president who was formerly a New York real estate practitioner, where, anybody that knows about New York commercial real estate knows that, you go through a negotiation with somebody like that, you're walking out making sure you have the pieces afterwards. You're just happy the negotiations might be ending. So I think you have this dovetailing of situation. I think the market kind of understands it and doesn't get, particularly in the U.S., as ruffled as you might think. Mike,
S&P Investment Advisory Service projecting S&P 500 index at 2,915 by the end of this year. We are 2,793. It's a very modest upside for the second half of 2018. You say the markets are not getting too ruffled, but 120 points over 6 months doesn't sound like a great deal of forward movement.
Well, let's think about this, Jeff. Look at what happened last year. We had a tremendous return, all right? And I think, we had a couple of things happen at the beginning of this year. We had the return of volatility. We had the the interest rate, gyrations, where literally, which really created most of the dislocation in the equity markets.
Mike, if we have plus 2% growth, we have double-digit earnings growth out of the United States, and as some people think the economy is reaccelerating, why can't we get more than 120 points before the end of the year on the S&P?
Jeff, the market still trades comfortably around 17+ times next year's earnings. Historically, the market trades around 16 times. So it's already it's a valuation question. And I will tell you, when the market it will probably get up to 18 times, but what will happen is the higher it goes on a multiple basis, the more vulnerable it gets to some sort of anomalous comment that comes out of something internationally. So it's a really interesting trade right there. But actually, the markets aren't in bad shape. They're handling this pretty well, I think.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.